This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Welcome to the Wise Investor Show. You're with financial planner Matt Anderson with the Wise Investor Group out of Reston, Virginia. I'm glad you're here because today's episode is built around a simple idea, addressing the most common questions that I hear as a financial advisor. The ones that tend to come up when markets feel uncertain, headlines feel loud, and it's hard to know what actually matters. So we'll be addressing questions like, will Social Security be there? Do I need a trust? Should I be doing Roth conversions? Do I need long-term care insurance? And of course, is now still a good time to invest? These aren't just technical questions, they're emotional ones. And they usually show up at moments when people are trying to balance logic with fear, opportunity with risk, and short-term noise with long-term goals. Now, my goal today isn't to give you quick answers or blanket advice. It's to help you think more clearly about these decisions, understand the trade-offs, and feel more confident navigating the uncertainty that comes with managing your financial life. So without further ado, let's get started. One of the most common questions I hear from clients, and honestly, from people at dinner parties and everywhere, is this: is Social Security even going to be there when I retire? Now, let me start with the short answer because I think this is important. Yes, Social Security is expected to continue. The real question isn't whether it disappears. The real question is how benefits may change over time. Now, to understand that, we need to talk a little bit about how Social Security actually works, because there's a lot of confusion out there. Social Security isn't a savings account with your name on it. You're not paying money in today that's being set aside specifically for you later. It's a pay-as-you-go system. Now, in simple terms, today's workers are essentially funding today's retirees, and that's mostly done through payroll taxes. And that's an important point, because even when you hear scary headlines about the trust fund running out, money is still coming into the system every single year. So let's talk about that trust fund issue without the fear-based headlines. According to the most recent projections, the Social Security Retirement Trust Fund is expected to be depleted around 2033, and the combined system, that's retirement and disability, around 2034, if Congress does absolutely nothing. But here's the key thing people miss. Depletion does not mean Social Security stops paying benefits. It doesn't mean bankruptcy. It doesn't mean checks go to zero. What it means is that benefits could only be paid based on incoming revenue. And based on current estimates, that revenue would still cover roughly 77 to 81% of scheduled benefits. So when people say Social Security won't be there, that's not accurate. The more accurate statement is benefits could be reduced if no changes are made. And this isn't some brand new crisis either. Social Security has faced major funding challenges before, most notably back in the early 1980s. And what happened then? Lawmakers stepped in and made adjustments before benefits were disrupted. Historically, that's how this works. Social Security affects tens of millions of people, and it's politically sensitive. And because of that, changes tend to be gradual and not abrupt. Now, when people talk about fixing Social Security, what kind of changes usually come up? Typically, policymakers discuss things like gradually raising the full retirement age, which is currently 67. That's probably the easiest, most palatable thing that they could do. Adjusting how benefits are calculated. They could also increase the payroll tax cap so that higher earners pay Social Security taxes on more of their income. Now, there's no single silver bullet, and that's why changes usually come in pieces and are phased in over time. So what does all of this mean for real-world retirement planning? Well, from a planning perspective, I never assume Social Security just disappears. But I also don't build a plan that depends 100% on projected benefits showing up exactly as promised decades into the future. In fact, sometimes we may stress test retirement plans, assuming partial benefits, something like 75 to 80%. Also, we may mess around with the cost of living adjustment that's being used so that we use something lower than the cost of living adjustment that we're utilizing in the rest of the plan. And that way the plan is conservative, and any positive changes down the road, they just become upside and not something you're relying on just to get by. Now, age matters here too. If you're already retired or you're close to retirement, historically speaking, you're the least likely to see major changes. If you're younger, there's more uncertainty, but you also have more time, more flexibility, and more opportunity to adapt. So here's the bottom line, and this is really the takeaway I want people to leave with. Social Security is very likely to be there in some form, but it shouldn't be your entire plan anyway. The smartest approach is to treat Social Security as a foundation, not the whole house, and good planning is what makes the rest of that house strong. All right. The next question I probably get just as often as the Social Security question is this one: do I need a trust? And usually when someone asks that, there's a little anxiety behind it, like they're wondering if they're missing something or if they're about to make a big mistake by not having one. So let me start with a simple answer. No, everyone does not need a trust, but some people absolutely do. And knowing the difference is what matters. One of the biggest misconceptions out there is that trusts are only for very wealthy people. That's just not true. Trusts aren't really about how much money you have. They're more about control, complexity, and what you're trying to accomplish. So first, let's talk about what a trust actually is. So at a high level, a trust is a legal tool that lets you decide who gets your assets, when they get them, and how they get them. And it can do that during your lifetime, after your death, or both. Now, here's where most of the confusion comes in. When people ask, do I need a trust? What they're often really asking is, do I need this to avoid probate? And probate, just so we're clear, is the court process that settles your estate after you pass away. Now, in some states, it's relatively straightforward. In others, it can be slow, expensive, and a very public process. Now, a trust can help avoid probate, but avoiding probate alone isn't always a good enough reason to have one. So how do you know if a trust might actually make sense for you? In practice, trusts tend to be more helpful when at least one of these things is true. 1, you want more control over how or when beneficiaries receive money. 2, you own property in more than one state. 3, you have minor children or beneficiaries who shouldn't receive a lump sum outright. 4, you're concerned about creditors, lawsuits, or remarriage issues. And 5, your financial situation is more complex and privacy matters to you. In those cases, a trust can solve some very real problems. On the other hand, if your situation is relatively simple, say you have a primary residence, retirement accounts with named beneficiaries, maybe you've got a taxable investment account or a bank account, then a well-structured will along with proper beneficiary designations or maybe a transfer on death designation may do exactly what you need without the added cost and maintenance of a trust. And that's another important point that doesn't get talked enough about. A trust is not a set it and forget it document. It has to be properly drafted, properly funded, which means assets actually need to be retitled into the trust, and kept up to date as your life changes. An unfunded trust, frankly, is one of the most common estate planning mistakes I see. So from an advisor's perspective, this isn't a question of should everyone have a trust. It's really a question of what problem are we trying to solve. And that's where good financial planning and good estate planning overlap. So as a financial advisor, my role is to help clients step back and ask, what does your family situation look like? What kind of control or protection do you want? And how complex is your financial life, both now and in the future? Sometimes that conversation clearly points towards a trust. Other times, the answer is no, you're actually in good shape without one. So if you're listening to this and wondering whether you need a trust, here's the takeaway. Don't assume you need one just because you heard a horror story about probate. And don't assume you don't need one just because your net worth doesn't seem high enough. The right answer depends on your goals, your family, and how you want your plan to work, not just what documents you've heard about. And when it's done correctly, estate planning, trust or no trust, it should make life easier for the people you care about, not more complicated. That's the real goal. And make sure you're working with a good estate planning attorney. You don't want to be doing this stuff on your own. All right. The next question I hear all the time, and this one has definitely been getting a lot of attention lately. It's this: should I be doing Roth conversions? And usually when someone asks that, it's because they've heard about it on a podcast or read an article or saw someone online making it sound like everyone should be converting everything to Roth right now. So let me start with the most important answer up front. Similar to the trust, no. Roth conversions are not automatically a good idea for everyone. But for the right person, at the right time, they can be incredibly powerful planning tool. Now, the key is understanding what problem you're trying to solve. At a basic level, a Roth conversion means that you're choosing to pay taxes on pre-tax retirement dollars now in exchange for tax-free growth and withdrawals later on. So this is really more of a tax timing decision. You're making a bet, hopefully a well thought out one, about whether taxes will be higher in the future than they are today. Now, most people immediately focus on the tax bill today, and that makes sense. I mean, nobody likes writing a check to the IRS. It's not a whole lot of fun. But the better question is, what taxes might you or your family face later if you don't convert? Because if you've saved heavily in traditional IRAs or 401ks, those dollars are all taxable when they come out. And that creates a few risks down the road that don't always get talked about. One big one is required minimum distributions, or RMDs. Once those start, you lose control over how much comes out and how much gets taxed every year. RMDs can push you into higher tax brackets, increase taxes on Social Security, and also increase Medicare premiums. In that context, Roth conversions can be a way to smooth taxes over time instead of letting them spike later. But Roth conversions aren't the only lever you have here. And this is an important point. In addition to considering Roth conversions, you may want to think about doing some proactive planning now to reduce how large your pre-tax accounts become in the future. And this is where forward-looking retirement modeling becomes incredibly valuable. Because when I model a retirement plan and I project RMDs, tax brackets, survivor scenarios, it can sometimes highlight an issue years or even decades in advance. And when you see that early enough, you actually have time to course correct. And that course correction, it might mean dialing back or stopping pre-tax contributions, shifting ongoing savings toward Roth contributions, either through Roth IRAs or Roth 401k contributions, or when available, using after-tax contributions, whether that's done through your retirement plan at work or just investing in an after-tax investment account. Now, those decisions don't create an immediate tax bill the way a Roth conversion does, but over time, they can materially reduce how large future RMDs become and how exposed you are to higher tax brackets later in life. In other words, Roth conversions are one tool, but contribution decisions going forward are just as important in managing future tax risk. Now, stepping back into one of the biggest longer-term risks, there's another angle here that's becoming more important, especially for families thinking about legacy. And that's what happens to these accounts when they're inherited. Under current rules, most non-spouse beneficiaries who inherit a pre-tax IRA are required to drain that account within 10 years. And here's the issue. Those withdrawals are fully taxable to the beneficiary. So if a child or a grandchild inherits a large IRA and they're already in their peak earning years, those required distributions can stack on top of their income and push them into very high tax brackets year after year after year. In some cases, the government ends up becoming the biggest beneficiary of that IRA. Now, Roth assets, on the other hand, they still have a 10-year rule, but withdrawals are tax-free, which gives heirs far more flexibility and control. There's also an important planning risk that affects couples, and this one often gets overlooked as well. When one spouse passes away, RMDs don't decrease, but tax brackets may. The surviving spouse goes from filing jointly to filing as a single individual, which usually means higher marginal tax rates at lower income levels, the same or even higher RMDs, and potentially higher Medicare premiums as well. And that combination can create a meaningful jump in taxes at exactly the time a household is down to one income. Strategic Roth conversions done earlier, while both spouses are alive and filing jointly, can help reduce that future tax burden and give the surviving spouse more flexibility. Now, zooming back out, timing matters a lot. Roth conversions tend to be more attractive if, number one, you're in a temporary lower tax bracket now, you've retired but haven't started Social Security or RMDs yet, you have large pre-tax account balances, and you have the cash to pay the conversion tax outside of the IRA. Those early retirement years are often what I call the planning sweet spot. Now, on the flip side, Roth conversions may not make sense if you're already in a very high tax bracket, you expect to be in a much lower tax bracket later, you don't have the cash to pay the tax efficiently, or you plan to leave most of your retirement assets to charity. This is where blanket advice becomes dangerous. Roth conversions are often talked about as an all-or-nothing decision, and in reality, they're usually far more effective when done gradually and intentionally, filling up tax brackets rather than jumping into the next one. So from an advisor's perspective, this isn't really should everyone do Roth conversions. It's more should you do them, how much, and when. And that requires looking at current and future tax brackets, RMD projections, Social Security timing, survivor scenarios, ongoing contribution strategies, and how you want assets to transfer to the next generation. Because Roth conversions and proactive contribution planning aren't just about reducing taxes during your lifetime, they're also about creating flexibility for your spouse and for your heirs. And before employing any Roth conversion strategy, because taxes are involved, you want to make sure that you're working with a good tax advisor to review that strategy just to make sure that it's appropriate for your particular situation. We're going to take a little break here, and we'll be back to finish up with a couple more of the most popular questions I get as a financial advisor. We'll be right back.
Violent stock market rotation, growing divide between winners and losers, and AI disruption fears. But might one man's trash be another's treasure, with opportunities emerging amid the churn? Tune in every week as we discuss the latest financial trends and what investors need to know to learn where to find value in a frenetic market and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James & Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James & Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James & Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. You're with Matt Anderson, and today we are addressing the most popular questions that I receive as a financial advisor. Before the break, we started out answering the questions, is Social Security going to be here in the future? Then we answered the question, do I need a trust? And third, we answered the question, should I be doing Roth conversions? All right, the next question I hear all the time is this: do I need long-term care insurance? And this is another one where people are often asking because they've seen a headline or they've heard a scary story or had a conversation with someone who went through a difficult caregiving situation. So let me start once again with a clear answer. No, not everyone needs long-term care insurance. But for some people, it can play an important role in a well-thought-out financial plan. Now, the real question is, how would long-term care impact your plan if it happened? And how do you want to deal with that risk? Now, because long-term care planning isn't really about insurance first, it's about understanding risk, choices, and trade-offs. When we talk about long-term care, we're talking about things like extended home care, assisted living, or skilled nursing care. And often the concern, it's not just cost, it's also the burden on a spouse or family members and the loss of control if planning hasn't been done ahead of time. Now, here's where people often get tripped up. Long-term care insurance is sometimes marketed as something everyone should have, but that's just not realistic or accurate. From a planning perspective, long-term care insurance tends to make the most sense for people who fall into a certain middle ground. If your resources are very limited, insurance premiums may strain your cash flow, and you may end up relying on other solutions. If your resources are more than sufficient, you may decide to self-fund the risk and keep full flexibility. So long-term care insurance often becomes more compelling for people who say, a long-term care event, it wouldn't bankrupt us, but it would seriously disrupt our plan. Or, I don't want my spouse or kids to feel financially or emotionally trapped. Or, I want more control over where and how care happens. In those cases, insurance isn't about maximizing returns, it's about risk management and peace of mind. Now, it's also important to talk about how the long-term care insurance landscape itself has changed, because it's very different today than it was 10 or 15 years ago. Historically, long-term care insurance offered a lot more leverage. Premiums were lower relative to benefits, and policies were often structured assuming very optimistic claims experience. That world doesn't really exist anymore. Over the last decade, many insurers have exited the traditional long-term care market, and we've seen a shift toward hybrid products, often life insurance or annuities with long-term care riders, which are optional benefits that are attached to life insurance or annuities. These newer policies can solve certain behavioral issues, like the fear of using it or losing it, but there's an important trade-off. Simply put, you pay a lot more per dollar of long-term care benefit than you used to. The leverage just isn't what it once was. And that matters because it reframes how long-term care insurance should be viewed. Today, this is much less about preserving an estate for heirs or optimizing returns, and much more about protecting against an outsized risk that would meaningfully change the trajectory of your plan. In other words, given the cost and the reduced leverage, long-term care insurance increasingly needs to be a true need and not necessarily a nice to have, at least in my opinion. That makes the planning conversation even more important because insurance isn't the only lever to pull. For some families, long-term care planning may involve structuring assets intentionally. It may involve setting aside dedicated funds. It might involve using home equity strategically, coordinating caregiving expectations realistically, or deciding in advance how much risk you're truly comfortable retaining. This is another area where forward-looking retirement planning and modeling really matters. When we model different scenarios, especially for couples, we can see what happens if one spouse needs extended care, how the surviving spouse is affected, and where the real pressure points are. Sometimes the plan clearly shows, yes, insurance meaningfully protects what you've built. Other times it shows, hey, this is a risk we could probably absorb without sacrificing independence or long-term goals. And there's also a timing element here. Long-term care planning is generally about planning ahead, not scrambling later. Waiting too long can limit options, increase costs, or remove insurability altogether. So this isn't about making a decision quickly, it's about making it intentionally. Now, from an advisor's perspective, the question isn't, do you need long-term care insurance? The better question is, if a long-term care event happens, what do you want that experience to look like for both you and for the people you care about? And once that question's answered, the role of insurance or other alternatives tends to become much clearer. So here's the bottom line. Long-term care insurance is not a requirement. It's not a failure if you don't have it, and it's not the right solution for everyone. But ignoring the risk altogether can leave your plan and your family exposed. All right, the last question, and this one probably comes up more than any other. Is now still a good time to invest? And what's interesting is that this question almost never comes out of nowhere. It's usually triggered by something, a scary headline, market volatility, political news, recent market high, or a pullback that makes people nervous. In other words, the question itself is often a signal, not so much about markets, but about what we're feeling in the moment. Sometimes it's fear of loss. Sometimes it's regret from a past experience. Sometimes it's the temptation to wait for clarity. So before even answering the question, it's worth recognizing this. When someone asks, is now still a good time to invest? There's usually a cognitive or emotional bias that's at play, often without realizing it. And I actually did an entire episode on this a few months ago where we broke down how psychological forces silently influence financial decisions. So how things like loss aversion, overconfidence, anchoring, and confirmation bias affect decision making. Now let's get back to the question. It is now still a good time to invest. Now, the reason this question gets asked over and over again from different people in different decades is because there is never a time when investing feels completely comfortable. Sometimes the market feels risky because it's down. Sometimes it feels risky because it's at highs. Sometimes it feels risky because of uncertainty. But if you're waiting for certainty, you'll almost always end up waiting too long. And this is where cognitive biases really show up. Loss aversion makes downturns feel unbearable. Anchoring makes us fixate on prior market levels. Confirmation bias makes us consume news that reinforces whatever we're already worried about. None of that means that you're doing something wrong. It just means that you're human. But it does mean that reacting emotionally can quietly pull us away from long-term goals. Here's something I've seen consistently as an advisor. People tend to worry most about investing when 1, markets are volatile, 2, markets are near highs, or 3, headlines feel especially negative. Ironically, those are often the same environments that cause people to hesitate and miss opportunities. Which brings me to this important point. Is now a good time to invest is usually the wrong first question. The better question is, what is this money for and when do I need it? Because investing isn't about short-term predictions, it's about time horizon. If this is money you'll need in the next year or 2, it probably shouldn't be exposed to market risk at all, regardless of market conditions. But if this money is for retirement that's years down the road, or long-term financial independence, or legacy planning, then the bigger risk often isn't market movement, it's not being invested long enough. Markets go up, markets go down, volatility is normal. What's not normal or healthy is constantly changing course based on emotions of the moment. And here's where another bias shows up, what I often like to call freezing. Because the alternative to investing, it's usually not some clean, well-timed decision. It's sitting in cash and just waiting. And here's the trap. If markets keep going up, you start to feel like you've missed out. And then you tell yourself you'll wait for the next opportunity to get in. And that opportunity may never come in a way that feels comfortable to you. On the other hand, if you get lucky and markets do go down, ask yourself this honestly. What are the chances you're going to invest when the news is worse and the headlines are scarier than they are today? In my experience, when people are sitting safely in cash, the answer is not very likely. Freezing feels safe. It feels responsible. But over time, it can quietly turn into permanent inaction. That's why waiting often doesn't lead to better decisions. It just leads to more waiting. That doesn't mean you have to make some big dramatic move all at once. For many people, a disciplined, systematic approach makes far more sense. Investing gradually, rebalancing intentionally, and making sure that risk aligns with both goals and your emotional risk tolerance. That's not about timing the market. That's about building a system that protects you from your own biases. And this ties back directly to that earlier behavioral podcast episode I did, because the goal isn't to eliminate emotions. That's impossible. The goal is to design decisions so emotions don't get to drive the bus. Now, another important thing to remember, investing doesn't exist in a vacuum. Good investment decisions work best when they're coordinated with cash flow planning, tax strategy, risk management, and long-term goal design. Sometimes the right answer isn't changing what you're invested in, it's adjusting how the plan is structured or how much risk is appropriate. So from an advisor's perspective, when someone asks me, is now still a good time to invest? My answer usually sounds something like this. If your plan is clear, your time horizon's appropriate, and your investments are aligned with your goals, then the question isn't whether now feels comfortable, it's whether staying disciplined serves you better than reacting. So here's the bottom line. There will never be a perfect time to invest. There will always be reasons to wait. And there will always be headlines designed to pull focus toward the short term. But successful investing isn't about predicting the next market move. It's about staying disciplined, diversified, and aligned with what actually matters. And when investing is done intentionally and supported by awareness of our behavioral tendencies, it becomes far less about timing the market and far more about letting time, patience, and good planning do the work. So as we wrap up today, I just want to zoom out for a moment. Every question that we talked about in this episode, will Social Security be there? Do I need a trust? Should I be doing Roth conversions? Do I need long-term care insurance? And is now still a good time to invest? They may sound different on the surface, but they're all driven by the same underlying thing: uncertainty. Uncertainty about the future, uncertainty about markets, uncertainty about taxes, health, family, and timing. And what I hope came through today is this: good financial planning isn't about predicting the future or having perfect answers. There are very few always or never answers in this work, but there is a consistent process. Clarify your goals, understand the trade-offs, be honest about the risks, and make decisions based on your situation, not headlines or trends. So thanks for spending your time with me today. And as always, if these questions are coming up for you, you don't have to navigate them alone. Thoughtful planning starts with the right conversation. Feel free to reach out to us at the Wise Investor Group. You can find us on Google, and we'd be happy to see how we can help you out. As always, I wish you continued wise investing, and I'll see you next time.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.